Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Michael Willis, lead portfolio manager of index funds. In this edition, we talk about investing in the broad markets, but doing it with a slightly different approach. That technique is equal weighting, and we dive into this concept and what might make it a better choice for investors in today's podcast. So if you have any questions or comments, make sure to send them in to podcast@zacks.com, and don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Michael right after this. Okay, Michael, thanks for joining us. So we're going to be talking about investing in the S&P 500 today, but not in the way most people might expect. You like the idea of using an equal weight approach. Why do you think this is a better way to invest in the market?
Thank you, Eric. Yeah, I think the equal weight is a little-known younger brother of the S&P 500 that I discovered a couple years ago. I always preferred the equal weight process over the market cap for momentum reasons. I was much more of a value player than a momentum player. So when I discovered the S&P 500 had a younger brother put out about 14 years ago now, that beat its older brother 10 out of 14 years, I was excited. So the reason I think the alpha that's achieved by the equal weight methodology in the S&P 500 is somewhere around 200 basis points. And I do think it's sustainable. And the reason is it really corrects an intrinsic trading flaw that's built into the market cap model. And I don't know how many of your listeners are aware of this, but the S&P 500 standard index weights 50 of its constituents with over 50% of the assets of the index. So ours does just what it sounds like. We equally weight the constituents over time. But the reason I think the alpha is sustainable and it's not just a cyclical thing is that if I'm a portfolio manager and I buy the 500 companies within the S&P 500 and I'm operating a market cap weighted, the standard version of the S&P 500, and let's just say 250 of them go up and 250 of them go down, I'm required by the methodology of the market cap to purchase more of the positions that went up and to liquidate a portion of the constituents that went lower, effectively buying high and selling low in layman's terms. Whereas in an equal weight model, let's just have the same scenario, 250 go up, 250 go down. The methodology we use requires us to liquidate the positions that are now overweighted, so the positions that went up, and to purchase more of the positions that are underweighted, and of course those are the positions that went down during that time frame. So effectively, it forces the manager to buy low and sell high. So we are excited about that very fact because people wonder why there's positive alpha between the equal weight S&P 500 and the actual index. And they say, oh, it's because the cap is a little smaller, because they're not as heavy weighted at the top, which is true. But the reason we think it's sustainable is we think that it's not just a large cap, mid cap issue. We think it's a better trading methodology built inside the index.
Okay, so you kind of view it as a self-correcting index, but maybe we can talk a little bit more about the mid-cap versus large-cap issue that you sort of brought up. So does it have a significantly higher tilt towards mid-caps than what we might see in a market cap-weighted index?
Well, okay, the way I view it is this. It doesn't have a tilt at all. We don't have a dog in this fight. What we claim is that the S&P market cap has a tilt to the top 50 super caps, super mega caps in the portfolio. So our claim is that we don't tilt at all. We just, if you like the 500, the top 500 largest U.S. companies as selected by Standard & Poor's, we just hold them equally, and we don't take favorites, whereas the market cap version does take favorites. So, of course, if it's going to overweight the top 50 of the largest 500 companies in the U.S., with over 50% of the portfolio, obviously our market cap is significantly less than theirs. But it's not a bias, Eric. It's a decision to remain neutral on the cap side of things. And we already are in the largest 500 companies out there. So whether or not we want to, split hairs on whether or not it has a mid-cap bias or a large cap or a super cap bias is not the real point, in my opinion, because you're already talking about the largest 500 companies. So the way I would like to look at it, if you split into deciles, which is 50 stocks, slices of the 500, so you have 10 slices of 50, and you look at the performance over the last 10 plus years of those deciles, the top 50 are one of the lowest performing deciles out of all 10 of them. And so if you were going to take a bias and lean one way to try to get better performance, we certainly wouldn't put our bias on those super caps, even though that's the direction the market cap went on their methodology. So yes, there is a significant difference, to answer your question, but we don't have a bias. So we don't think we have the bias toward away from super caps. We think we don't have a tilt toward super caps. So we've already carved out that the largest 500 companies trading publicly in the U.S. according to Standard & Poor's. So of those, we like them all. We like to hold them equally, and we think it gives you better diversification to own them all equally.
And I'm guessing you have a similar take on the sector. I don't want to use the word tilt, but a sector breakdown for your type of equal weight as opposed to the S&P 500 market cap weight.
Right. There's actually a much more even, in I'm looking at, I don't have Standard & Poor's market cap in front of me right now, but I'm looking at ours, and I just looked at Standard & Poor's about 2 weeks ago. Definitely shifts around the sectors a little bit, but I think you're going to find it's a better diversification. It's not, I think information technology is at the top of the market cap sectors.
Yeah, for market cap, it's about 22%. But sorry, go on.
Okay, good. Our information technology is at 13.3% at quarter end, so quite a difference there in spreading around the diversification between all the sectors, I think.
Okay, and maybe we can talk about how this strategy has performed over the last couple of years. Maybe let's take a look at 2016 in particular. Obviously a very up and down year for the markets. How did equal weighting do over the course of 2016?
Okay, 2016 we had great alpha in positive alpha in 2016. Over the last 14 years, it's outperformed its older brother 10 out of 14 years. If you're looking for trends, the equal weight does better in an up market, and the market cap does slightly better in a down market. So last year, the S&P did 11.96%. We did 14.8. When I say we, the equal weight index did 14.8. So we had good alpha last year. The year before, we got soundly beated. The EWI got soundly beated by the market cap. So it was one of those 4 out of the 14 years that the market cap did well. And if you remember, last year was really an up and down. Ended up being a fairly flat year, but there was a lot of up and down, and the market cap just did soundly better. If you're looking for kind of patterns, if you go back to 2008, obviously so what happened during a year where the market just got slaughtered? The equal weight index was down 39.72%. The market cap, S&P 500, was down 37%. So the EWI was off almost 300 basis points more than the market cap. However, in 2009, the year the market came back, the Standard & Poor's market cap was up 26.46%, and the EWI was up 46+%. So it has the ability to snap back a lot faster, and I think it's a margin of the downside. Yes, there's a little bit more downside risk on it, but to me, it's a very acceptable downside risk when you measure in the upside snapback potential on the EWI.
And it sounds like part of this snapback can also perhaps be attributed to the whole idea of buying low, selling high. You think that's fair to say?
Yeah, I really do, because if you remember, in 2008, the market started to get smashed in August. It then got worse all the way through to the first quarter, like March of '09 is what I'm remembering, really bottomed out at that point. But so you had several quarters there where we rebalanced, selling those positions that were higher and buying the positions that just did the worst. So I fully agree with your conclusion or your suggestion that maybe that had something to do with it. I would agree with that.
Okay. And you know what? Let's switch gears a little bit here and talk about a way for investors to sort of play this with the index funds S&P 500 equal weight index product, the symbol INDEX. Great ticker there, by the way. I guess I'm curious.
Thank you.
I guess I'm curious why an index fund was chosen as opposed to an ETF structure.
Good question. In doing our analysis of the market, and I was an FA, a financial advisor for 20 years, these are just my own numbers, but in my own experience, about 25% of investors out there enjoy day trading and really trying to actively beat the market. And I think 75% I would categorize more as a longer-term investors. They have other things they really want to focus on during the day and week. And so they're not sitting there trying to trade it during the day. And it's more for, they're investing for their nest egg, and it's their safe money. You know, they want long-term returns. They wouldn't be in the equity market if they didn't want long-term growth returns. But it really is their money that they're planning on retiring on. So they don't, in our experience in talking to them, they don't want their money being exposed to day traders, shorting entities, and derivatives, which ETFs are great. They're definitely a chassis of investing. Obviously, one of the hottest products on Wall Street, and there's a lot to like about them. They have great tax advantages being in an ETF. But you have to measure in, I think, what else comes with that. And the investors we're going after are the ones that don't want their nest eggs more susceptible, I should say, to either hyper trading or to day trading or shorting or derivatives. And so I don't know how close you were watching the market 2 August ago, but we had that flash crash. Remember when the market opened down about 1,000 points?
Yeah.
The equal weight, one of our competitors, great company, by the way, they have an ETF version of the equal weight, and it was down over 40% in the first 30 minutes of trading and actually stayed down there quite a while before it popped back. And that is during a period of time where the underlying constituents were down any part of the day was just single digits. And so it was somewhere around just under 7%. So the fact that they were off over 40% for such a long period of time, yes, it's a flash crash. Yes, it was corrected. But I think at the time it had $12 billion in assets, and that's almost a $5 billion hit coming out of the fund in 30 minutes. And I think if it was just something that was only going to happen once every 10 years or something, it wouldn't be as big of an issue. But I really do think we're headed into a period where volatility is going to be part of investing. And so we actually love the structure that we're in. We didn't have any issues on that flash crash day. We strike one NAV every day. There's no load, so you buy it at the same price you sell it. And our longer-term shareholders can rest knowing that their portfolio is not being shorted during the day or derivatives being sold off of them.
Okay. Let's also talk about some other key factors investors might want to know about INDEX. So you got a 25 basis point net expense ratio. Are there any minimum investment requirements? And then what also for the dividend reinvesting? How does that work for your product?
So what we do is our basic goal is to bring the best indexes to our shareholders at the lowest cost. And so this is our flagship fund. We're really excited. We think the S&P 500 Equal Weight Index is one of the best kept secrets on Wall Street. One of the key reasons is it can be held as a core holding. And I think a lot of managers will tell you it's one of the most difficult things you can do is beat the S&P 500 over time. I tried to do it for 20 years, and I can tell you there's nothing more mind-numbing than talking to clients over and over again as you do their quarterly reviews and have them ask, well, so how did we do against the S&P 500? You just, as an advisor, I'm sure if any are listening, they can relate to this. You just cringe because you say, well, the S&P did beat us this year, but here's why. We were invested, diversified into bonds, and we were in these other sectors to give you a much more conservative beta, volatility. And we would talk about these things, and of course there's a measure of truth to all of that. But in the end, when I really began to look at the S&P 500 and the 500 companies that you're diversified into, I could no longer tell my clients that I thought they wouldn't be diversified in an S&P 500 fund. I couldn't tell them that with honesty. And so what we've decided to do, we've picked what we believe is the best index on the market, the best brand name. We think we have the best ticker out there, and the easiest one to remember anyway, with INDEX. And we want to be the lowest cost available on this. And one of our competitors has $10 billion in the market. They're at 40 basis points. So we're at 25 basis points. And we're excited about that because we want to pass that savings on to the client. We can do that by staying small. We use the Alps chassis. They're our fund administrator and distributor that works behind the scenes. They're the same ones that do work for the Spider products and SPY, one of the largest ETFs on Wall Street. So we think they're one of the best chassis in the market for mutual funds. And we could get $1 billion ticket tomorrow, and it's not going to really change anything at our company. We can still remain flat. And I think that's part of the secret sauce, because we think the market is going to, the next Wall Street is low-cost index investing. So in terms of dividends, you asked about that. Those are paid out at this point once a year toward the end of the year. We can pay them out at different times in the year. If for any reason we start accumulating a lot of dividends, we can push them out semi-annual or as needed. But right now, the last 2 years, we've done it at the end of the year in December.
Okay. Well, Michael, best of luck to you in the index fund. I think this is a great discussion on equal weighting, and thanks for joining us today.
All right. Thank you, Eric. Good talking to you.
All right, everyone. That was Michael Willis, lead portfolio manager of index funds. The index fund that he discussed trades under the symbol of INDEX, and you can see more about their product at index.world. Well, hope you enjoyed this edition of the Dutram Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find the Dutram Report on Stitcher or iTunes and give us a review there, and let us know if there are any topics or questions you have for us at podcast@Zacks.com. Until next time, for Zacks.com, I'm Eric Dutram.